For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by John Nelson, financial advisor at NelsonCorp Wealth Management. Welcome back, John.
Thank you for having me, Brandy. Happy to be here.
Financial media really makes a big deal about the actions of the Federal Reserve. Why are they so important, and what are people watching when it comes to what the Fed says and does?
Yeah, so it oftentimes is what the Fed says and maybe sometimes not always what they do. So the Federal Reserve really has two primary goals. They're in play to maintain price stability and maximize employment. So they have many tools in their arsenal to accomplish their goals, and they use them, and has increased significantly over the last decade of how involved they've become. But if we look at two key metrics, is the Fed sets short-term rates. So short-term interest rates usually increases borrowing. You see that pick up. We've certainly seen those depressed interest rates in the amount of spending in the economy. That has been very effective. The other is quantitative easing. So if we think back to the 2008-2009 financial crisis, that quantitative easing was a big catalyst in trying to get the market and the economy back in reasonable shape. And that's where the Federal Reserve is buying bonds from banks, again, injecting a lot of money into the United States economy at that time.
Could you drill down a little bit on an example of some of these concepts of liquidity?
So what I have with me today is a chart that helps illustrate this. So if we look at the Fed's role or the liquidity in the market, for quite some time it was relatively modest. But from the 08-09 financial crisis, it increased dramatically. So these free reserves that we're looking at here is just the reserves, the amounts in excess of the amounts that the banks are actually required to have. You could see there, the stretches from 08 to 2014 and 2020 to today. Those stretches of low interest rates, lots of liquidity, have been very beneficial to the equity or financial markets here in the United States.
So how might excess liquidity impact investors' decisions?
Yeah, I'd say, like many things that we discuss on the show, this is just one key item. It should be taken into consideration with many other factors. We literally look at thousands of different indicators to help make these decisions. But in a vacuum, the liquidity has been a catalyst. When valuations sometimes look high in the U.S. markets, liquidity in the short term has kind of helped overcome that, and markets have responded very well.
John, as always, thanks for joining us today.